See, Avan, you are in a range, and then you perhaps have to just acknowledge that and admit that you are in a range. And let's look at the setup here. Now, when I say range, it's a very, very narrow range. Last 8 sessions, Sunday, Monday, Tuesday, Wednesday, Thursday, Friday, 8 sessions, 2 weeks almost. You've just been in a 250-point range. Now, a variety of factors are at play here, but the net impact is that even though global markets have been in a rara mode, Nifty has, or benchmark indices really have been in a range. The long positions, and I'm talking about the FNO long positions, the data which we use as FI long short portfolio, that also seems to be tilting more in favor of where short rather than long, which means, just to explain that data, looking at this data, it is visible and it is apparent that the long positions are reducing and hedging and short positions are going higher. So the institutional activity is telling you that nobody is betting on any kind of a reversal, nobody is betting on any kind of a sell-off, but maybe it's time to take some chips off the table or time to start buying that insurance. So we are in that phase of the market where you have two options: take some profits off the table or start buying some insurance. And unfortunately today we'll talk about the global markets. That support in the global market, which in a sense has been the real tailwind frankly in my book, that also seems to be just waning away slightly. So it would be I would say it will not be a difficult Wednesday morning, but it would be a very thanda market, so to speak.
We'll be in a limbo, I guess.
Yeah, it'll be a reality check of sorts that will come into the picture today. And as you pointed out, the Asian markets this morning aren't also doing much. There's a cut of 1 to 1.5% across the board. The Nikkei is down 1.5%. Kospi 2 is coming lower. And all of that because there is a news flow that has happened overnight, which is very, very important and critical for the global markets. And that's the fact that Fitch has downgraded the US sovereign rating. They've downgraded the rating to AA plus versus AAA earlier. Remember, the last time we had seen a downgrade come in for the US sovereign rating was back in 2011 after the debt discussions were happening there. S&P had cut the rating to AA plus, and now Fitch has also gone ahead and cut the rating. For now, Moody's stands at AAA, but there is a rising risk that there might be a cut coming in from Moody's as well. Now, what are the reasons that Fitch has given? Well, they talk about fiscal deterioration, they talk about the growing debt burden, as well as the fact that all of these discussions which have happened over the last 2 to 3 months has eroded the fiscal confidence that the world and the market had in US as a sovereign. Of course, no surprise that US Treasury Secretary Janet Yellen is disputing all of that and saying that US economy still continues to be very strong. But a very interesting move happening there, Nikunj. And of course, there is commentary coming in from Mohammad El-Erian, etc. as well, saying that the vast majority of economists and market analysts looking at this are likely to be equally perplexed by the reasons cited as well as citing. And overall, the announcement is much likely to be dismissed than having a lasting disruptive impact on the US economy. But this is something we have been discussing, right? India stands at a very low rating when our fiscal is improving, fiscal strength. And what was happening with UK, what's happening with US now, and they still had AAA ratings.
So realistically, this was long overdue.
Yeah.
Nobody's surprised with what they're essentially saying. Now, will this have a very strong impact on the way how things are going to move in terms of the near-term stability of the financial market? I doubt it very much. Of course, you will get a rebuttal from the US Treasury Department, which is what Janet Yellen has immediately indicated. Global commentators will not be very happy with the reasons which are cited, but what Fitch is saying, I think, is pretty much the obvious, which is that post the extension of the debt ceiling, the balance sheet of the US government has only expanded. Bond yields are rising. They are going to be running into a rough weather in terms of servicing this huge debt. But that's like yesterday's story. So in terms of a market positioning, I don't think this has come out as a nasty surprise. This is not like, oh, world's going to change because of this downgrade. But incrementally, I guess now rating agencies, which I've always maintained have had a slightly, they had a bent towards what the developed economies have done. I guess now they are also realizing that you got to start calling spade a spade. So nothing new, frankly, if you ask me, but this is something which is unlikely to have a very major impact in terms of the financial market setting. So you look at Asia this morning, it is not that Asia is falling flat. It is not that US markets have completely gone, belly up in the US futures market. So it will have a sentimental rub off. I don't think anything more than that.